Hi friends, welcome back. I want to give you an update on the stock market, what's going on with the Fed, and some job numbers. So let's just jump right in here. Headline, Dow closes 300 points higher in Friday rebound, but registers worst week in 2024. So we were green today in the markets, but yes, this was a bad week compared to the rest of the year. Other notables is that Intel is down. There was some news article that they were losing a bunch of money on something. They're always losing money on something. And then Tesla had an article about them. Reuters came out and said that they canceled their $25,000 low-cost vehicle. Elon Musk claims that's lies, doesn't give any details, and then now he's saying they're going to introduce something on August 8th. So I'll do a separate video on that. Who knows? There's always drama going on with over Tesla, but those are the notables that were down. Otherwise, everything else up was green. You can see there's another headline. Federal Governor Bowman says additional rate hike could be needed. So we're talking hikes now if inflation stays high. And this is actually quite interesting because remember the market wanted 3 cuts. Actually, they wanted more, but that was been kind of the rumors. I keep saying they could probably stand pat or even raise. That's a possibility. And now this is part of the discussion. And this is her actual language here. We'll read it. It says, while it is not my baseline outlook, so not the baseline, not necessarily, the par, I guess I should say, I continue to see risk that at a future meeting we may need to increase the policy rate further should progress on inflation stall or even reverse. Moreover, she also said reducing our policy rate too soon or too quickly could result in a rebound in inflation, requiring further policy rate increases to return inflation to 2% over the long run. So again, we have one Fed saying, hey, maybe we should raise. There's a possibility of that. The Dow, despite that kind of stuff, the Dow was up 0.8%, S&P up 1.1%, and the NASDAQ up 1.2%. We also had some job data come out, guys, and you can see headline here, U.S. jobs growth of 303,000 outstrips forecasts and weighs on rate cut bets. Meaning that if the economy is strong and we're creating jobs and all these kind of things, why should we need to cut? This is some predictions by the market or betting. You could say however you want to say it though. But regarding this is in the May meeting. The market is thinking that there's a 93% chance that there will be no change. So no cut, no raise. Also too, this is in the June meeting. This is sort of what the market's betting on, giving it roughly a 50-50 of a small cut. So that would be 0.25. And then you can look ahead further. If you want to look at July, maybe by then it'll be roughly, it's hard to really, because there's like multiple numbers here, but we'll just say there's a 48% chance that maybe there'll be a small cut. And then if you actually look ahead to December 2024, this is where it gets kind of like all over the map. So, the odds of staying where we are today, 2.7%, maybe a couple cuts, maybe 30%, something like that. So again, this is all over the map, and that's a long ways from now. So I would take this one with a grain of salt. Moreover, this is actually kind of interesting as well. If you want to compare the jobs data that came in, I said it was 303,000 compared to previous. So we're kind of in line of what we've been up to. We are less than what we were before back in last year, was it January 2023. Unemployment has actually ticked down a bit. You can see here, I know this is a kind of a long chart. This is from like 1950 forward. But the reason why it's good to see the long chart. So if we are around, well, actually I'll draw it better. If we're around here, this is the current unemployment rate. This is the red line I'm drawing, the current unemployment rate. You can actually see we are lower than historical, right? And you can see at other times in history that was been higher. So you could certainly make the case that employment is a little bit low of where it could go. And in fact, the Fed could, be trying to tick that up a bit. Basically, if you make the cost of money more, right? So it's harder for people to borrow money, harder for people to use credit cards because interest rates are higher, et cetera. It'll slow things down. But at the moment, unemployment at 3.8. Now, there's some caveats with this. The jobs, where are they? And I've told these guys this several times. There may be jobs for you, but may not be necessarily what you want. So the jobs being added are healthcare, hospitality, and construction. You can actually see it really clearly on this chart here. So again, the job gains, you have construction being one of them. It's led by healthcare, and this also included private education. So they're kind of in the same category. Then you actually had government was in there as well, and leisure and hospitality. So if you're not like looking to get jobs in these, or you can talk about retail, but if you're not looking to get jobs in any of these things, you're probably like, not so great, right? Moreover, I'll mention too that the jobs in these may not necessarily pay what you want it to pay. The government's an interesting one because this money doesn't just come from nowhere, right? Government jobs come from taxpayer dollars, so you guys are clear on that. Moreover, there we had another Fed person come out and saying, this is from Logan, saying much too soon to be thinking about cutting rates. So it was definitely mentioned in many of the articles that this could just be election kind of stuff, meaning that keep saying whatever you need to say, but don't actually doing anything until maybe even next year. So we'll see on that. I like I said, my personal opinion is either be stand pat or raise, especially if unemployment is coming the way that it is, and we're still growing an economy. But obviously all of these things, because people always want to know what's going to happen in your particular situation, it's going to be different for everyone, right? Depends on what city you're in, and depends on what industry that you're in. Some industries are slowing, like for example, we talk about EVs all the time, not so great, right? Whereas it looks like you can get a job at healthcare or maybe in the government, that kind of thing. Moreover, if you want to take a look at the markets as a whole here, this is actually different ways to look at it. I like to show you guys this stuff just to get your mind thinking about different things. So in terms of the month, the mid caps were the one that are the gainer in this past month, 1.15%, and the Nasdaq has been down 1.95%. So you can track it there. And there's different ways you can sort these things. I always like to see like kind of what's moving and what's going up, what's going down. So for example, in the past month, energy has been the big winner, right? Up 12.56%, whereas say real estate's been down 4.65%, right? And then the other ones are kind of in between. You can also sort it by are you interested in value stocks, dividends, momentum, etc. So momentum stocks have been down. You guys can see that right there, whereas dividend might be going up a little bit. And then high dividend yield up 1.88, right? So things kind of go in cycles of what is hot, what is not. In a higher interest rate environment, tech tends to struggle more. And if they're going to keep the rates higher, I would expect that also. Moreover, this was an interesting one. So this is the salary increases, right? So year over year percent change in average hourly earnings in the USA. So why do you track this kind of thing? So for many people, they want to get paid more to keep up with fuel costs, food costs, housing costs, etc. So according to this, this is for hourly, average hourly earnings. So in January 2022, year over year, you're getting a gain. You're essentially a raise of around 5.8%, something like that. Now you may be getting an increase in your salary compared to last year of 4.1. So that is higher than inflation, right? In terms of like how much money you get paid compared to how much things cost. However, the wage gains don't necessarily mean that it's been kept up all the way. So for example, let's say 2 years ago, prices on meatloaf, or actually don't buy meatloaf, let's say beef, went up like 300%, right? Like say crazy amounts, or prices on chicken went up like crazy, or salad, lettuce that is, went up like crazy, or going out to eat went up like crazy, etc. And yes, maybe you got 100% increase on your pay, but if prices are up 300%, not so great. And now fast forward to today, even if say for example your wage gains are above inflation what it was last year, has it caught up to say the past 5 years, etc.? And that's going to depend on your particular situation. I'll give you a really interesting example that someone asked me about recently in the comments, but I do pay attention to everything. It's just I can't get to everything every day. There's always stuff to talk about. When you give a raise, to certain kind of jobs. So in this example, in California, it's now a $20 an hour minimum wage for fast food workers, which is really interesting. If you've been to LA or San Francisco, some of these cities, it's really expensive to live there. And you're looking at, average home prices like $1 million, that kind of thing. And we just, I think it was like a couple days ago, I just shared with you guys a story that came out. It was like 550 cities in the USA where average home price is above $1 million. And the sort of just basically what it's telling you is the cost of living is going up, right? And so then people need to get paid more, obviously, to live in said cities. So I'm not necessarily like against, raising people's wages, not at all. Just you have to always keep in mind that this is all part of a larger system, right? So if you raise wages, say at McDonald's, etc., what's McDonald's going to do? So if they want to maintain their profits, they're probably going to raise prices, chances are, right? And then the question would be, if McDonald's say raises their prices, right, in order to maintain this basically margins, will people still want to go to McDonald's? And that's always the fundamental question. And so this is sort of why we track consumer confidence in these kind of things. So, for example, let's say, for example, if Tesla or Ford or whatever, car company, their union workers say, hey, we need to get paid more, etc. And then, they're like, okay, fine, we'll pay you more. And then they have to decide, okay, what are we gonna do about the stock? Because they also want to please their investors, right? Because they certainly could just for example, eat into their margins and not take so much profit, and then, pay their workers more. But then the stock's like, well, you're not making so much money anymore, and the stock would go down, right? So this is always the fine balance. And then you have to deal, again, with keeping your investors happy, keeping your workers happy, and also too running a sane business, because again, all of these things work together, guys. That's sort of why we track all of it, right? Do people have enough money to buy said products? Are said products at reasonable prices for people? Can people borrow money to buy said products, right? So I know for people who are new to the markets and new to stocks and all these kind of things, it can be overwhelming. But when you get into this stuff, it's actually really interesting and important to track every day, so you're not just freaking out all the time because you don't understand what's happening. It's really good to understand that also too. And I mentioned it in several videos, that this is just the USA. I mean, this kind of how can I say, global economic world that we're in is all connected. You have to mention, say, what's going on in China, right? Because, for example, if companies are making said products, and say they have to pay their workers more here, maybe we're better off just paying workers cheaper in other countries. Let's say for example, China. And then you see, okay, what's going on in China? Well, workers there, are they willing to work for cheap or not, right? Are there jobs alternately that they can go to? I mentioned this one because, and I know we're talking about China, USA, and all these things at the same time. This was a really interesting article because basically the headline was, hey, we're going to be paying fast food workers more. And now schools are like, whoa, well, we can't get any workers to work in our cafeterias. Which I thought was really interesting. It says, what does it say? Minimum wage is so good that schools are worried they can't compete for cafeteria workers. So the point is, when you look at anything, just understand it's part of a larger system, right? When you do something in one area, in this example, fast food, that's going to affect hiring in another area, right? Or for example, when you say fire a bunch of tech workers or finance bank workers, etc., then you have all of these highly skilled workers going into other industries, and that'll affect the job market and the job search there. So everything's connected all the time, and guys, I really know it can be really quite complicated. There's so many things to track, and that's why I enjoy having you come back every day, because we're part of a community to go through everything together. And that's why I always say the same thing as well. I'm always curious to hear what's happening in your neck of the woods, right? So when I read, for example, someone wrote a comment yesterday that I think the data said that 5 cities in Connecticut were average home price was over $1 million, and someone's like, I thought it'd be a lot more because I live in Connecticut and it's ridiculously expensive, right? So that kind of stuff. It's always interesting to hear local person's perspective on that. So last time when we were in the USA, we saw help wanted signs everywhere at all of the restaurants and things like that. So when you start raising wages at fast food workers for $20 an hour, I think that's going to be really, really interesting to see if workers are going to take that or not. We're also in a post what you want to call it, global pandemic world, where people are kind of more concerned about their what's the word to say it, health, mental health, right? So they don't necessarily want to take jobs just for the money, they rather their free time. And then that's more kind of your higher end workers, where your lower end workers who complain that they're not getting paid enough. Moreover, you guys know this, you go to restaurants and stuff like that, and a lot of these workers also too have been asking you for tips. That's actually been a really controversial thing in the USA, to where should you tip at the counter service? Should you tip if you are just picking up your food, say picking up pizza, not delivery, not staying in the restaurant, these kind of things. But it's actually everywhere. So basically, there's just a lot of people really struggling, and we'll see if what this does to prices. So anyway, I know it's complicated stuff, but I enjoy talking this stuff with you. I think it's fun. And again, my personal opinion is that the Fed should just stay pat. And if the economy is as good as they say it is, there's no reason necessarily to cut. Anyway, so that's my thoughts. I want to hear yours as well, and I'll catch you next video.